So we have, oh, it's go time. It is 1 o'clock. So we are very aware of everyone's time. So we're going to go ahead and begin. Welcome to PayMaster's webinar. We're going to be discussing two things today: the pitfalls in completing your W-4, as well as the Employee Retention Act. Now, you are very lucky to have Romeo Chico, our CEO, who is just a ball of knowledge. He will be presenting both of these items today. And just a little disclaimer before Romeo takes over. As you know, with the pandemic, there were a lot of supply chain issues. And evidently, you cannot buy razors in Palm Beach County right now, which is evident by Romeo's new do and Billy Goat thing he's got going on. So he's every bit as professional and knowledgeable as he was pre-hair, but there's a supply chain issue, so just go easy on him. But you guys, thank you so much for being here. Welcome. And Romeo, I'm going to let you go ahead and take over.
All right. Well, thank you, Rhonda. All right. I'm going to take over.
While he's taking over, just a reminder that if you want to ask any questions, there's the little hand icon at the bottom. Also, if you want to be unmuted, let us know if you'd like to speak. And one more time, this is being recorded. Okay, Romeo.
Thank you.
You're welcome.
All right. So screen is shared. As Rhonda said, if you have any questions, you can put it out there in the Q&A or the chat, or I may not get to your question right away if I think that question is going to be answered on an upcoming slide, but we'll get through everyone's questions by the end. This is turning out to be somewhat of a monthly webinar that we've been hosting. We used to do our annual conference and pack a full day, and now we're just bringing up topics when they come timely and important. We had one last month. This is this month, and at the end of the webinar, we'll introduce one for coming up in May. The slides and what I will give is for discussion purposes only. I'm going to try to pack a lot of information on two different topics into about an hour. I can easily speak an hour on just the W-4 and probably 2-3 hours on the ERTC. So we're going to try to bring in a lot of information here. As Rhonda mentioned, the sessions are recorded, and we're doing that for the people that cannot attend. We will post these out to our website, and if you get our newsletter, we'll have the link in there to where that is available. If you do not receive our monthly newsletter, you can go to paymaster.com, and towards the bottom of the homepage, there is a sign up for newsletter. All right, so today I'm going to cover the W-4 first. I'm estimating it'll be about 20 minutes, and then we'll jump over into the employee retention tax credit. All right, so back in 2018, or actually 2019, I was apparently bored one night, and I pulled up. I was able to find 30 years of withholding tax tables going back to 1988. So I was kind of curious as to how withholding has progressed over the years. And we hear about taxes going up, and I was like, well, let's see what it is in reality. So I took $500 of taxable wage, and back in 1988, an employee making $500 a week, the red line is someone who's single, and the green line is someone who's married. So a single individual making $500 had just over $80 of federal income tax withheld. And we see that amount progressively declines. Here is 2008. We had our recession for a couple of years, so taxes decreased quite drastically there, as we see. But 2 years later, 3 years later, 2011, it came back up to a level of where we were pre-recession. And that goes through 2018, and we did have another significant drop there, But I don't have on this chart 2019, it did level off again. If we jump to today, I pulled the tax table. Again, on someone earning $500 taxable wage on their check, and someone who is single is now down to about $28, and someone who's filing married on their W-4 is practically zero. I think it's about $1 and change. So that, comparing back to 1988, where it was about $61, that's we have seen a significant drop in income tax withheld from an employee's check. And that's on purpose. The federal government wanted to stimulate the economy and put more money into employees' paychecks each week. They did not want employees to have a big refund at year end. They felt that the economy would be better by having more money consistently throughout the year than this big lump sum at year end. So this new W-4 came out, and I have a quote from the IRS commissioner when this came out. It said the primary goal of the new withholding tax tables are to provide simplicity, accuracy, and privacy for employees, while minimizing our burden as the employer and payroll processors. But with that change, we have seen it has been somewhat of a burden, but I think much of that is on a misunderstanding of the form and employees using the 30+ year knowledge of allowances is affecting that. So to start, let's we look at the pre-2020 W-4 form. That's what it is referred to in IRS guides. This old form was pretty simple. Most people check the box, single, married. They would put the number of allowances on there, 1, 0, and that was pretty much it. And as an employer, many of you just handed the employee this first page of the W-4. You threw it on your copier, you copied the first page, and you handed it out. But this was not the entire form. There's actually 3 more pages behind this, and but most kept it simple and just did this first page. And by doing that, you were maximizing the amount withheld from your check, causing that big refund. But if you flip to the second page of the W-4, there was this whole 2/3 of a page on how to calculate an allowance. And you add one for yourself and one for your spouse. And I love that most people didn't even catch this. If you add 4 for every eligible child. So if you were a single person with a child tax credit, you're actually had 5 allowances. So it was kind of weird how those allowances translated and were calculated on this form. But and that was just one schedule. There's another schedule underneath that on what if you have additional income. And then there was another schedule on the next page of, what if you have multiple jobs? So this was the W-4 form. It's all of these schedules and taking this information and bringing it up to that very short first page. So in regards to the government saying we're simplified the W-4, they really did. They eliminated most of these schedules and came out with this 1-page form. There is a little worksheet that I'll show you in a moment. But the problem is people still have that mentality of single 0, single 1, married 2, and again, that no longer exists. We do still have the single, married, head of household at the top. And that's usually all people will will complete. It states here, only complete steps 2 to 4 if they apply to you. Otherwise, you just sign it and turn it in. But we're going to jump to the step 2, and this is the biggest pitfall I see on this form. And that's because there's a lot of writing and this very small checkbox. It's kind of hidden all the way over to the right. It doesn't have the highlight and the red arrow that I put on here, and people don't see it, but it is a very important box. And to zoom in on that, what this step says is if you have more than one job, or if you are married and your spouse works, those are cases where you need to check this box. And I've been answering probably daily questions from companies that send in, my employee had to pay $2,000 in taxes, or they're short $1,000, they owe money. And when I do a little bit of investigating, I look and I find, they indicated they were married. And then I look to see if this box was checked, and it's not. So that basically states that, yeah, you're married and you're the only one that has household income. So this box does need to be checked in those cases where there is some other income on that tax return. And it's a little bit of a tricky box. And as I said, there is a worksheet on the next page. Whoops. No, actually, sorry, I wanted to show you just briefly how this box affects withholding. Every payroll system uses this the standard withholding tax table. You can find it. It's publication 15T. If you go out there and search for it, it used to be called the old circular E form, but the tax table has kind of gotten a little more complicated, that it's its own publication now. And in the publication, there's the calculators on how to actually calculate the tax to the penny. But there's this great cheat sheet that lets you just kind of look up on a table. So this is the 2022 tax table. You have to find the pages for your payroll frequency. In this case, I selected biweekly. And then you'll notice there's columns for the filing statuses: married, head of household, and single. And down the left, you find your taxable wage on a particular check. And I did skip down so we can see here it starts at 0. But if we go down here, an employee who earned $1,000 of taxable wage on their check, if they did not check that box, they had 0 withholding come out of their check on $1,000 of taxable wage. Whereas if they check that box, they now have $52 coming out of their check. And we can see, if we look across, it makes a difference if you are head of household or if you're single and you have a second job. That checkbox makes a big difference. And if you're talking about a married couple and they both have a job, and both of them forget or neglect to check that box, that's about a $3,000 difference in withholding that is going to translate right to their personal tax return, where they're going to end up owing. So there is one worksheet on I believe this is on page 2 of the W-4, and this is a pretty important worksheet. And it is if you do have 2 jobs or 3 jobs, or if you're married and your spouse works, because that checkbox assumes that all jobs earn the same amount of wage. So if you and your spouse both check the box and you make 40,000 and the spouse makes 60,000, you can't simply check that box. That box will still not give you enough withholding. It's this worksheet that will compensate for 2 jobs that are at different amounts or more than 2 jobs. And I was part of the pilot program on evaluating the new W-4 before it came out, and where the commissioner said this the new form ensures privacy. What was on the initial W-4, it actually had lines on it for the employee to indicate how much they make from other jobs and how much their spouse makes, and and that violates privacy, because you wouldn't want to necessarily give your employer your tax return, in essence, how much everybody in your household makes. So this worksheet is made for the employee to fill out. They're it says on the top, keep for your records, and this is where they will indicate how much they are making at their other jobs or how much their spouse makes, and it translates down to the bottom line. Whoops. To basically be an additional amount of withholding that would appear on the actual W-4 form. It is complicated, for the typical employee to read and comprehend this. I used to say it's almost like they need a tax return preparer just to fill out their W-4 form, because it is like filling out a tax return. On the bottom of the W-4, there's even boxes there for them to indicate whether they're itemizing their deductions and how much to put there. Another pitfall, we don't see it too often, is people still think of that allowances, and I've seen a number on this line, like they'll put 1 or 2 for how many qualifying children they have, and again, this form is to translate that to a dollar amount. So on this line where you have claimed dependents, this should be a multiple of $2,000, and this line should be a multiple of 500, and affect your withholding in that regards. The IRS understands that this form is complicated, and you'll find throughout the instructions. So here on that worksheet right here, it gives a URL. And actually, if we look at the first page of the tax return, right up here, oops, it says it also. They made a tax calculator on how to complete the W-4 form. And if you don't know that link, which is again on every W-4, if you go to irs.gov, you can click on Pay and Tax Withholding Estimator. And that's going to bring the individual to a series of interactive questions. I didn't get a screenshot of every question because it is interactive. Depending on what you answer on one, it will change the subsequent questions. But you can see it starts with what's your filing status. And it is accurate to a point that it wants the employee to have their recent check stub in front of them, because it will ask them questions about how much a tax has been withheld so far this year, or how much are your wages so far this year. And at the very end of that process, and it shouldn't take the person too long as they have the information in front of them. I threw this in there the other day, just threw in a what if, and what it does at the end is it provides you with exactly how to complete it. It says, all right, select single or married filing separately on this, and you need to put $39 in additional withholding on line 4C. I didn't indicate I had 2 jobs. I didn't indicate I was married, so it didn't tell me to check that box. Otherwise, that would be a step here. And it even gives a link to a pre-filled W-4 form with those settings. So the employee can just click that, pull it up, sign it, and then hand it to their employer. So it is a very easy process. I do get a lot of questions of like, the employer saying, what should I tell my employee, or how should I advise my employee? And I will always say, try to avoid that. Don't advise your employee how to fill out their form, because then if you are advising them and they are short withheld, it's going to come back to you and they're going to say, well, you told me to fill it out this way and now it's wrong. So if all possible, direct them to the IRS app, and that is going to give them the most accurate way to complete the form. There was even a way over in the results section at the very end of the process, that now, and I hadn't seen this like a couple of years ago, but it now allows the employee to set how much of a refund they want to get back. So doing this setting, as we see here at the top of the screen, if I set this and this was my accurate answers, it is going to work out that I'm going to have 0 refund and I'm going to owe 0 at the end of the year. But if the employee actually wants to get a refund, they want to use this as some sort of forced savings account, they can set, oh, I want $1,000 refund, and it will recalculate the settings on how to complete that form to get that $1,000 refund. So, and I believe that is my conclusion to the W-4. Looks like it was about 20 minutes. So I was figuring about 20 minutes on this and 40 on the ERTC. And take a look in the chat. I don't know if there are any questions.
There's one.
Why still include the allowance if the IRS is giving us more in each paycheck? So I'm not quite sure why still include the allowance. So there is no longer allowances on the W-4. On the old one you had, if I jump back here, you had your allowances, but allowances, again, no longer part of the W-4 form. It's now just...
I know, but it has the deduction, so it's kind of like the same.
Yeah, so it does have this. So in claim dependence, and that is because for each number of dependents you have, you pay less in income tax. And the kind of the magic behind this is when you do your income tax return, you get $2,000 per child as a reduction in your tax. And so what is happening here is you put that $2,000 on this line, and what our payroll system does, or any payroll system does, is it will say, all right, you're a biweekly payroll. So we take that $2,000, we divide it by 26, and we go, all right, this is the amount of reduction of income for this particular payroll in order to withhold less taxes. So I guess the other side of that is we used to hear people that would complete the old W-4, and if anyone who's been in payroll long enough, we used to see W-4s come in that would have 8 allowances or 10 allowances, or we've seen some that would go 99 allowances. And their goal, it wasn't because they had 10 kids or 99 kids. They knew that the bigger that number is, the lower the income tax came out of their check. For whatever reason, they just wanted less to come out. So if you want to translate that to the new form, I guess what you can do, let's get back to that new form, is on this line, you can put, I don't know, $50,000 for on this line here. And the system is going to treat that 50,000 and go, okay, well, 50,000, divide that by 26. We're going to reduce your taxable income by that amount in order to look it up
No,
on
I
this tax
understand.
table.
I understand all of that. What I'm saying is, if they already reduced our tax deduction, why add that line anyway to reduce it even more? So now when they're doing their taxes, they're like, oh my gosh, I owe the IRS. Why? That's the issue I'm having now with all my staff members.
Yeah, and again, I suspect it's, well, and if you send me over a couple of employees, I'm happy to look into their specific form settings and their income. Yeah, there was one I looked at the other day. It was they filled out the form, married, didn't check the box, and the employee had $26,000 in income on that W-2. And the amount of tax withheld was like, it was $118. And the client said, how can you withhold $118 on $24,000 of income? That's too low. The employee owes. And, I am a CPA, although I don't do but like 5 personal returns. When you look at the 1040 form, a married couple, their standard deduction, I think, is about $24,000, something like that. So if that person was married with 25,000 or whatever that amount was, when they complete their 1040, they're going to take that 25, they're going to reduce it by the standard deduction. And that person would only have like $1,000 of taxable income. And the tax would have been, that $100 amount. So our system, or the tax table, worked perfectly. But the problem was that person had a spouse, and the spouse made money and did the same thing. Didn't didn't check that box, didn't have enough withheld. And so now if that spouse made 24,000, so now we're looking at on their personal tax return, let's say 50,000 less the $24,000 of standard deduction. There's now about 25,000 of taxable, and the spouse didn't have enough income tax withheld to account for that. So it is complicated, and again, and that's why the IRS came out with that calculator. I think it's a great tool. I've heard a couple of employers say that they will walk their employee through the calculator and help them, so not necessarily give them advice, but assist them with the IRS website, walking them through. And then again, like I said, at least it's not yourself giving advice that may not be in their best case scenario. So there's a question about sending new forms. As soon as you update in any payroll system, the withholding form, it's from that point forward. I will say that at this time of the year, we're 3 months into the year, and somebody says, "Oh, I needed to check that box because my spouse works, so I'm going to go check the box and submit a new form." You're already 3 months behind of withholding, and again, I think the only way to accurately account for that in making a change mid-year is by going to that IRS that website and letting the IRS system calculate what should have been withheld and how that translates to additional withholding. So by the time we get to December 31st, 2022, there's enough in the bucket so they don't owe money. Oh, I did have a request about, so this webinar is more for employers and administrators. I was asked the other day about providing some guidance to employees. So I am looking to do a recorded session where I will walk an employee through the form, provide resources, and I will have that posted. Let's see, I may try to get that done before the end of the month, so before the May 1st newsletter goes out, so when we send out this recording, so that way you have an employee with a question, there's yet another resource and they can watch that. I'm going to try to make it short for an employee's attention span to get what they need.
And Romeo, I just wanted to throw it out there too, that if somebody did find themselves in a situation where they wanted to catch up on their federal tax, so they do something like submit their form and they say they have additional withholding, our system does allow you to store tax settings with an effective date. So you could even, there's a scenario where you could say something to the effect of, okay, they're going to have this additional withholding. It would be for the remainder of the calendar year. And then as of 1/1 on the following year, you could have the identical tax settings without the additional withholding. So essentially you allow that person to catch up without necessarily a commitment to that same amount for the following year where they have the ideal tax settings.
Yeah. Perfect. All right. So I don't think I see another question out there. So again, we'll put this information out on the May newsletter, and if you do have any scenarios of employees, you can send it to your payroll specialist, and I'll take a look and see what may have gone wrong in that case. All right, so now on to the next topic, the employee retention tax credit. This is another topic we've gotten a lot of questions on. There's a lot of confusion out there. Let's see if this plays. We made a short 1 minute.
Counting on me, and when the state shut down my business, I didn't know. What was that?
Oh, that? Yeah, that's just the employee retention tax credit you're entitled to.
Employee retention?
Hey, by any chance, have your gross sales been down in 2020 or 2021?
Yeah. I'm entitled to all of this?
Mm-hmm. Up to 26,000 per employee. All you got to do is answer this little questionnaire, and we'll take care of the rest.
Okay. Done more paperwork at the dentist's office.
I bet you have. By the way, if we can't find you any money, we won't charge you a thing.
Sounds great. Hey, where does all this money even come from anyway?
Say hi to Gary. Gary.
Nice to meet you.
Hey, what can we find you?
All right, so employee retention tax credit. There's a lot of misinformation out there, and I've put together this list of 7 myths that have come across that people do not think they're eligible for it. If you received a PPP, if you didn't have a drop in revenue, if you weren't shut down, this only applies to small businesses, nonprofits not qualifying. So all these are reasons that are old news, in essence, or myths. And the reason behind all of this confusion is the Employee Retention Tax Credit originally came out in the CARES Act back in March 2020, and it has changed and been modified across 3 different acts and at least 3 different IRS notices and guidances over the more than a year and a half here. So I'm going to try to address some of these myths and talk about how businesses do qualify. You can qualify in essence under 2 general categories. The business was full or partially suspended, and this is quote from the IRS, that you're limited commerce, travel, or group meetings, or, and that's a big or, the business revenue decreased during a calendar quarter. And this takes effect from March 13th, 2020 through December 31st, 2021. I have a little asterisk there, and I'll talk about why that's there in a moment. Looking at the suspension piece of it, it is a suspension by a federal, state, city, county, local government order. We've seen cases where a business on literally one side of the street does not qualify and a business on the other side of the street qualifies because they're in different cities. And some cities had their own government orders on restricting business. The order can be in any of these categories: reducing your operating hours, capacity, procedure, or even your supplier is suspended. So I give some examples here on the next screen. I think that's the best way to kind of showcase some of these. So we all know, like restaurants, they were limited to just takeout only for a couple of weeks back in the early in the pandemic, and then they were able to open up indoor dining, but it reduced capacity. They were only allowed 25%, 50, 75%. So that is a restriction in your ability to do business. That is a partial restriction. Businesses were not able to operate 24 hours a day. There was a time period where businesses needed to shut down to sanitize their operation. They were not able to run 24 hours. Occupancy or capacity is limited. So, for example, there's a state where they required tables to be 6 feet apart from each other. So by moving tables, businesses had to reduce the number of tables that they served their customers with. So that is a limitation. What else? Inability to perform a service you provided previous. So, for example, the best example is dentists' offices. They were not able to do procedures like teeth whitening or orthodontics adjustments. These are procedures that were seen non-essential, and back early on in the pandemic, it was all about stopping the spread and preserving PPE. Not using masks and gloves for somebody to get their teeth whitened and save those essential items for essential procedures. So the rules are different for different years. And so one of the myths was this only applies to small businesses. Well, for 2020, that is the case. It only applies to businesses with 100 or less full-time employees. And there's some confusion over that because everybody thinks of the PPP and the full-time equivalent employees, or if you're ACA, there's full-time definition there. For the ERTC, the definition of full-time employees is very specific. So you can likely have 200 FTEs or full-time equivalents, or you can have 150 employees but still qualify. Each employee is measured on their own to determine if they work more than 130 hours per month. And the look back period is 2019. So if that is the case, then you needed to have been suspended based on one of those rules we talked about previously, or your business must have had a revenue decrease by at least 50% in any quarter in 2020 compared to 2019. So 50% is a pretty big bar to hit in a decrease of revenue. You had to have been severely affected by the pandemic. But again, it is an or. So again, for if you have a restaurant or that type of business, you're suspended. And it doesn't matter if your revenue it could have gone up during the pandemic, but as long as you meet one or the other, you qualify. The amount per credit of the credit is half of the wages you paid your employee, up to $50,000, up to $5,000 per employee. So if you have 10 employees, that could be a maximum of $50,000 that you're eligible for if you were affected during that year. For 2021, it's a little easier to obtain the credit. And the first thing the government did was they expanded it to larger businesses. So your business can have up to 500 full-time employees. Again, they're measuring to a pre-pandemic year of 2019. The suspension rule still is in there. You could be suspended, or your revenue only has to be down by 20%. And the comparison for 2021 is you still look back to 2019. You're looking back to a pre-pandemic year to see if your revenue is down. So it is easier on the revenue side, which is good because many states and counties were out of suspension orders by the time we got to 2021. The credit amount that you're eligible for significantly increases. It now jumps to 70% of wages paid to each employee, up to $7,000 per employee per quarter. So whereas for 2020 it was 5,000 total, now for 2021 it's $7,000 for each quarter that you were affected by either still being under suspension of some sort or a revenue decrease. The ARP Act modified the ERC in a positive way, and it opened up to new businesses. What President Biden was looking to do was to provide an incentive for businesses to start. In essence, if your business was not open by February 13, 2020, you were not eligible for any COVID relief. You were not eligible for PPP. You were not eligible for ERTC. You were deemed to have opened your business knowing there was a pandemic, so you were not eligible for anything. So in essence, the RSB came in and said, all right, if you did open after February 15th, and you're a small business, less than $1 million in gross receipts, then you will get 70% of wages you paid your employee. You don't have to prove a revenue drop because you just opened, and you don't even have to have been suspended. You just had to have opened your business after that date. and be somewhat of a small business with less than $1 million in sales, and you will get up to $7,000 per employee per quarter, maximum of $50,000 per quarter. And it is only for the or I should say the last 2 quarters of 2021. So third and fourth quarter, 2021. Just looking to see, I thought I saw a question pop up. There are some exclusions on the ERTC. It is an employee retention tax credit. So any payments you made for severance pay during that time don't count because you didn't retain the employee you were separating. So that does not count. Any wages you paid for, and the theme here is if you paid for wages with government money, those do not count as wages eligible for the ERC. So if you did receive a PPP, that just has to be carved out. And there's some different ways that you can take the PPP money out of your eligible ERC funds. The same goes for other government money that you may have received. So if you received the Families First Act, sick leave, reimbursement on your employees, or if you received a workforce opportunity tax credit, those wages do not count for the ERC. Household employers are not eligible at all. So I know we do have a few household companies out there. And this was a rule change that came into play in August 2021. Owners are not eligible for their own wages. So kind of looking back as just the title of it is Employee Retention Tax Credit. They really didn't care about the owners paying themselves. And so your wages to yourself do not count towards that credit. And then wages paid to family members. So if you're a greater than 50% owner of the company and you have family, that family does not, their wages do not count. And that was really, I think, just put in there to try to combat abuse and fraud. You know, somebody hiring all of their family and paying them just to get back, 50 or 70% of the wages as a tax credit. The way that the refund or the credit is claimed is it is filed on a 941X, which is basically an amended 941 tax return. There is a 3-year amended return filing, and that just has always been in the IRS. After you file a return, you have 3 years to amend it. So everything we're talking about on ERC at this point is for 2020, 2021. So hopefully all of your tax returns are long filed by now, so it is an amended return. So for 2020, 1, 2, 3, we're looking at sometime next year, we'll start phasing out the ability to file for 2020 quarters. Each quarter is filed on its own. And unfortunately, right now, I don't know if you've seen the news out there. The IRS is just severely impacted by COVID. They were not able to do a work from home pretty quickly. So they're limiting their workforce, trying to reduce the spread of COVID back in 2020, and to this day, really. They have been severely backlogged. We're finding that it is taking the IRS about 8 months from when a return is filed for them to process the return and send out the check. We see some come in a little bit quicker, and we've seen some take a little bit longer. And unfortunately, that's just what we have to work with. I have seen some news out of the IRS in the past couple of weeks. The new commissioner has made a commitment to hire 10,000 workers. They are mandating overtime. They're putting in more automated phone systems that you can maybe get your own question answered through a telephone or a robot. They are moving 700 employees into the business processing. And so hopefully these changes will make a difference in how fast they're processing these returns, and just all returns for that matter. But some good news is that when the IRS does process, they are including interest, and the interest goes back to the date when the original return was filed. So if you file for let's say second quarter 2020, you're probably going to get about 3 years of interest on that. You're going to get from 2020, 2021, 2022, and possibly by the time you receive this refund, if it's filed today, is going to be in 2023. So there's a little bit of a delay, but again, they're happy to pay out interest on this. It is complicated in performing the calculations. I put a slide here, as we saw in that little commercial that I had. This is something that we can perform for your company, even if you're not a client. We can evaluate, we research the suspension orders, and calculate that qualified wage optimally. So, all right. So I think I actually went through that a little quicker than I was expecting. I don't know if there are any questions out there while I'm